Hi guys, it's Sam here today. Today I've got a great video to do with what is value investing and what is growth investing, what the difference is, which one is better and how they performed over the last good few years. So without further ado, we are not financial advisors. Hit the like button, hit the subscribe button, it really helps us out an awful lot. And look, we're going to get straight into this and explain what they are and what my opinion is and how I would personally kind of go about it. So, growth versus value investing, what is the best? They're both two of the main ways that people invest and put their money. They put it into growth stocks or they put it into value stocks. So there's various people that are more for value stocks like Warren Buffett and Charlie Munger. All of their portfolios are based off value stocks. And growth stocks are more for, say, younger investors with a higher risk tolerance, and the way to try and beat the markets very easily is by trying to find these really hot growth stocks. But they come with different pros and different cons, but look, we're going to get into that now. So, growth is fast, it's furious, it's been very, very successful over the last few years with big tech, high growth rates, normally trade at a premium compared to the rest of the market, and they're also very high risk and high volatility. With value stocks, they're boring stocks, they're normally blue chip stocks, lower price multiples, limited growth, and lower risk and low volatility. So it depends on what your risk tolerance is, what your volatility tolerance is, to which one you would go for. So they're defined by three different characteristics that we're going to go through. So the growth of a company is what defines whether it's a growth stock or a value stock. So they're generally growing faster than the market, higher returns that attract investors in the first place. They're growing at least 20% per year. They're usually smaller companies, younger companies that are just starting and going through an exponentially long growth phase. Harder to get high growth rates when you are a large company like Berkshire Hathaway or like even just like ExxonMobil. They're a large company, but they're declining because of clean energy is now becoming the way forward. So you think about if you're a large company, you have to do an awful lot to grow your revenue like significantly. So like Procter & Gamble, like they're known for just making toothpaste stuff. They bring out a new toothpaste brand, it's not going to grow their revenues like 10-15%, where like it might have if you were a smaller cap company. So the only companies that are kind of seem to be exempt from this rules are the likes of Apple, Amazon, Facebook, Google, and all the big techs. Really, they're still growing like astronomically every single year. Like, so even though they have massive caps, they're still growing rapidly as well. So the second characteristic is a stock valuation. You're trying to find a bargain, you're trying to see if a stock is on sale, solid fundamentals selling for less than what its intrinsic value is, and reasons why it could temporarily be down is a temporary headwind for the company, such as bad press and temporary losses, even just things like COVID and stuff. They might have been down because they're not like a work from home stock or like a construction or travel or them kind of ones. They're looking to see if they have a lower PE than the competition and compared to their historical PE as well. So the stock's valuation, you can understand that for one of our previous videos, which I'll be linking up here as well, where I explain PE and how to value a company in great detail. So this is an example of valuation. It's kind of similar to what I did in the previous video, but you'll understand it here too. So the Market Moves Media has a PE of 5, whereas competition of Blank Slate Media has a PE of 10. You're looking to see if Market Moves has strong fundamentals, good management team, good product, and hoping that the PE will return to 10, like the rest of its competition, which will give you a good return. So that's kind of what you're looking for when you're doing a value proposition. The next characteristic is stock volatility. So you can see here from the two different charts, growth is a lot more volatile. It's up 50%, it's down 30%, it's up to 60 again. Where value is more of a steady of just 8% to 10% every year and gradually increases. So it depends on what you think as a person that you can deal with. Do you want to deal with these ups and downs, or do you want to have a slow and steady burner in your portfolio? So the pros and cons of these two different metrics. Growth, higher returns, Finding a growth company stock early on will likely make you rich. More exciting companies, interesting products, and just a general good buzz around them. Like they're not boring by any means. Like, and if you're into the company and into the product, like, you will really get absorbed into what they're doing. So the cons are high risk, more volatile, bought and sold based on results, priced for perfection if they have a really high multiple PE. Like an example of the CrowdStrike that we have, they have a really high forward PE and they're priced for perfection. They also have extremely high expectations, so if they don't live up to this, it will be reflected in the stock price. So value is, they're boring stocks, they're less volatile, less risky, they're generally well-established companies, so you know what you're getting yourself into because they've been around forever and you know exactly what it is. So the cons, you could potentially be waiting a long time to see profitability. Like, there's no good if you're putting in your money into a really good value stock right now, but you're not going to see a very good return for 20 years. It's not going to be very exciting and very appealing to you. There's also a value trap. So a value trap doesn't necessarily mean that the company's good just because it's cheap. Just because its PE is low and forward PE is low doesn't necessarily mean that the company is good. It can have bad fundamentals that can hinder the value of the stock in the future. So it's like you're buying a PC and the PC is terrible, but just because the company is trading at a low valuation, the companies, you need to make sure that they're not selling rubbish products to cover their sales. So what is better? According to the Bank of America, from 1926 to 2016, value outperformed growth with a 17% per annum and growth at 12.8% per annum. So that's just the average over that last 90 years. This is not necessarily a reflection of what's going to happen in the future. It's just based on past performance of the two different stock styles of investing. So if you look at here from 1993, you'll see that growth and value, they both have their ups and downs, but specifically in the last 10 years, growth has outperformed value over the last 10 years. When you have like the likes of Facebook, Amazon, Google really dominating the industries, like you can see that they're now taking over. Just a few of my final thoughts as well. Growth stocks do better in a bull market. You should always hold both growth and value stocks to be diversified. I made a video on this last week as well, which I'll be linking just in the top right here, and you can go into that and you can learn all about what it is to be a diversified portfolio. To understand the difference between value and growth, you need to understand what stock you're looking at. You need to understand, is that stock a value stock or is it a growth stock? You need to differentiate between what they are and understand it before you make the decision of buying it. Because if you have way too many growth stocks, if you're all growth stocks and you have no value stocks, you're going to be hit with more market turbulence than you would be if you have a balanced portfolio of value and growth. You need to ignore the fear, uncertainty, and doubt, as you'll always find cases of people saying that value is dead, it's never going to perform again, or you'll also see that growth stocks are done and there's a massive correction coming in the future. So you need to just make your own decision and try not to get it into your head of what is best and what isn't. Having a bit of both is definitely the way to go forward. So that just brings us to the end of the video there. I hope you enjoyed this. I hope you get a lot of value out of this. Please hit the like button, share this with everyone possible. We're really enjoying our first few weeks on YouTube and we're going to hit 150 subscribers in our first 3 weeks. So without further ado, I'll see you in the next one, guys. Bye. So known